As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. Today we have a returning guest, Alasdair Macleod of goldmoney.com is back with us here. He's an expert on the gold and silver markets and specifically about gold storage options. He's back here to talk with us with an outside the U.S. perspective on what's happening in gold. Alasdair, welcome back to Reluctant Preppers.
That's my pleasure, Dunnigan.
Now, if you could first give us a look outside the bubble. We've had several domestic U.S. experts on gold and silver talking to us about the disparity that they're seeing in physical supply and physical pricing for precious metals. If you actually want to take possession of your precious metal purchases inside the U.S., that's quite possible to do at a artificially suppressed price. But we're being told that it's masking, and it actually fits with the narrative that's popular in the press here in the U.S., and that is that precious metals are beaten down. They're clearly showing that they're not a rising value, and therefore not a place you should be considering to put your wealth, as opposed to encouraging people to keep looking at the stock market, and et cetera. So we're being told by U.S. experts that that's primarily a U.S. phenomenon, and that out in the broader international scene, physical precious metals are not necessarily available at those low prices. So we're asking you're outside our bubble, if you could give us the insight from outside the U.S., what are you aware of in general terms about availability and price points for physical precious metals?
Okay, I think we better sort of go back to basics on this. Basically, you've got two markets. You've got the real market, which is the physical bullion market. And you have got artificial markets, which are futures and also forwards. Now, the reason I call them artificial is that the people involved in those markets either have no intention of taking delivery at all, which is the case in the futures markets, or they probably don't have an intention to take delivery, which is the situation in forward markets. The reason I say probably with forward markets is that you can buy something forward. You can buy something forward in a forward market and take delivery at the end of that time. If, on the other hand, you buy something forward and you sell it for the same settlement date, then effectively you're not intending to take delivery of it, at the outset. So there are those two differences. Now, the point about the futures market is that you can manufacture artificial supply just by selling effectively uncovered futures into the market, because you just create supply. If you walk into the market and you sell 10,000 contracts of gold on COMEX, you have created supply that wasn't there before. So it is quite easy to drive the market down, literally just by walking in and selling stuff you haven't got. Now, if you're a bank, you can do that sort of thing. If you are a central bank dealing through a commercial bank who's a member of COMEX, you can do that sort of thing. And so this obviously leads to suspicions that the market has been manipulated downwards or managed downwards by the central banks and by the bullion banks who have naturally short positions, in other words, sort of supporting their overall interest by keeping the price of gold suppressed. So that's basically the background to the market. Investors, you've got two categories of players in the market, in effect. You've got investors, and investors in financial markets are people who basically buy when the trend is right. So if they see the trend going down, they won't buy. They might even short it. If they see the trend going up, they then jump on the bandwagon and buy. And that's sort of standard investment practice, really, in all markets. So I think that your listeners will be familiar with that. The second category of people are people who aren't really that price sensitive. They continue to, hold on, let me just get rid of this noise. They continue to sort of buy all the time. Now, I'll give you a very good example. This is my favorite example of the Indians. I first went to India in 1965, 66. The price of gold in rupees was roughly 170 rupees per ounce. Today, it's about 70-odd thousand rupees an ounce. So you can see that the family pension fund, which basically just goes into gold. And, every time there's a decent harvest, it goes into gold. When it's not such a good harvest, they use the gold as collateral to buy seed corn, seed for the next harvest and so on. It is the family pension fund, as it were. And so you can see that people like, the sort of the ordinary Indian person isn't actually all that sensitive to price. He basically, if he can get any supply and he's got the money to buy it, he will buy it. So you've got those two categories. Now, the reason this is important is that Asia, we're talking about Indians and Chinese, we're talking about Iranians, we're talking about Turks, we're talking about all those people. We're talking about over 3 billion people are natural accumulators of gold for the long term. Call it pension fund money. So over the period of this bear market, anyway, since 2011-12, the Asians have been accumulating gold, and the Western central banking system, the Western central banks and the banking system have been supplying the gold to them. So we've got to a situation where the level of stocks in the West are really very low. How low, we really don't know, because everything that happens in this market is effectively secret. So that is the background to the situation, and I think gives you some sort of handle on the difference, if you like, from outside America and what goes on in America. So to summarize, in America, you've got people who basically will buy into a rising trend, sell into a falling trend. In Asia, which is actually where the bulk of the world's population is, they have this different take. They basically continue to accumulate it. And if the price goes up, they may indeed accelerate their purchases because they think, oh my God, it's going up, we're going to miss it, sort of thing. So a little bit of that sort of trend chasing can come in, but we haven't had much test of that over the last 3 or 4 years.
So what I was actually hoping you would add to that was whether, in fact, people outside the U.S. are able to take possession of physical gold at the low prices that we're seeing inside the U.S.
Oh yeah, absolutely. Because basically, if the markets, let's say the futures markets, suppress the price of gold, then it creates the opportunity to buy gold, because otherwise you will always have an arbitrage between the markets. It's just the easy way to create supply for the market is not to actually deliver gold, but to go into the futures market and sell 10,000 contracts which didn't exist before you went into the market, if you see what I mean. Absolutely,
but how does that enable the physical, though, to be able to be delivered at that price outside the U.S. as well?
Because the arbitrage in the market is quite simple. If the price in the futures market is driven below the price in the physical market, then you will get bullion banks who will arbitrage between the two. So a lower price does actually create supply, but over time, the amount of that supply gets more and more limited, and you see this being reflected in the liquidity in the COMEX vaults. I mean, the gold registered for delivery is down at a very low level. I think it was something like 70,000 ounces the other day, which basically means that for every 550 odd ounces in futures, there's only 1 ounce available for delivery. So we just hope that nobody stands for delivery.
If we could turn your attention with us now to the topic of storage of physical metals, both you and a lot of other advisors that we've had on here have talked about the importance of, if you are going to own gold or silver, that you own it in a physical metal, not just in a paper contract, that sort of thing. Can you briefly overview to us what you consider to be the most advisable ways of holding physical metal, taking advantage of both whether people could have it in their own physical possession, have it under custodial care at a secured facility, and domestically where they live versus some offshore location, and why?
Well, I think really what we're talking about at root is getting money, which is really what gold is, out of the banking system. And this would be the case if you're worried that there is a systemic risk, if you like, in that because you're a depositor or because you have a cash account with a checking account with a bank, the bank goes bust, you're merely a creditor. So that is the fundamental reason that you would consider physical possession of gold. And as you rightly say, you can own it directly, so you can buy coins, small bars and things like that and own it directly. I think the two problems with owning it directly. Well, first of all, there's one good reason to own it directly, and that is to have a little bit in hand for liquidity purposes if the fiat currency world comes to an end. The two problems you have is that you really can only have coins, recognized coins. The problem with bars is that nobody is going to take a bar off you because they're worried that it might not be proper gold. They might worry it's tungsten plated with gold or whatever. So it would have to be reassayed before it becomes cash again, if you see what I mean. So that's something which you have to certainly bear in mind. The second thing is that if you have what amounts to a large amount of gold in paper currency terms on your own property, then you do open yourself to risk of sort of, if you like, theft. And some of the guys who'll come for your gold can actually be very nasty, like they will, I don't know, kidnap your daughter or whatever. But I mean, so I think there is an aspect of that which you have to think about. There's a security element in it. The alternative to that is to store your gold in a vault, and you can do that quite easily through a company like Gold Money, or indeed if you open a BitGold account. And the storage, you can select the storage where you want and which country you want. I mean, whether it's if you're in America, you would probably think, well, I would rather have it not in America. I'd probably have it in somewhere like Zurich or somewhere like Singapore, or wherever you feel comfortable about having your gold out of the control of your government. Because the point about the 1933 Gold Act was that it forbade people owning gold in America. If you had gold outside America, you weren't touched by it. It's quite an important point. I'm not saying that that's going to happen again. All I'm saying is that having gold in a different jurisdiction from your residence just makes it a little bit more difficult for a government changing the laws to actually catch up with you. So I'm not saying that you break the law in the future, but what I'm saying is don't make it too easy for the guys. And of course, the other point about having it in a vault in a jurisdiction where property rights are properly respected is that it's also insured. And in our case, in Gold Money, and also with BitGold, all the vaults we store in around the world, it's all insured. So you can. It's about as safe as you can get, really. And I think also another point worth making is that the physical possession in a vault has got to be preferable to anything representing paper. ETFs don't necessarily track the price of gold. I mean, we had a notice out on, I think it was on Friday, that one ETF has stopped taking orders, if you like, creating new ETF stock simply because they can't get hold of the gold. At least that's what they say. That, I think, it sort of comes into your earlier question. The supply of physical gold at these prices seems to be pretty limited now, and demand has really sort of cleaned out the available liquidity.
If we could turn our attention now to one of the reasons that people are concerned about the stability of the fiat currency system and why they'd be interested in owning precious metals in the first place, one of those signs that people have been looking to is fragility and signs of cracking or breakdown in the existing system. And one of the biggest blocks of the fiat system is the EuroZone. You recently, in fact just this week, wrote an article where you said there's an elephant in the room that might also trip up the planned outcome. That is the material and growing risk of financial instability in the EuroZone. While it is probable that no major problems will surface before June, there is a significant possibility they will. The Eurozone's banking system is somewhere between insolvency and bankruptcy, with the Italian, Greek, and Portuguese banks in intensive care. Eurozone government bond prices, many so overpriced they have negative yields, are certain to fall significantly at some stage, leading to an inevitable Eurozone debt crisis. Add to this the refugee problem, and we have the makings of an all-too-obvious Eurozone bust-up. If you could enlighten us further from your perspective there in Europe. In fact, you live in the UK, and the UK was one of the premier players in that drama that you were describing in your article as being a potential one to be the first rat off the sinking EuroZone ship. So if you could just give us in the US an update of what you're seeing in Europe of the health of the EuroZone.
Yes, indeed. I don't think it's any secret that the financial condition of the Eurozone is very, very risky. Basically, the banking system is undercapitalized. You have a split, if you like, between the more responsible northern countries, in which I include Germany, the Netherlands, Finland, and a few others, and the southern countries along the Mediterranean. Greece, we all know, is a real problem. The debt to GDP ratio in Italy is also off the scales. Spain is probably not quite as bad, though there is political turmoil there, and at the moment they don't really have a government with a majority. Portugal is a problem, and if you look at the finances for France, that is also absolutely shocking. It really is. So we have the potential, I think, for a real disaster coming out of the Eurozone. And it's a situation which is effectively being nursed by the ECB and also by the Germans trying not to rock the boat. And basically everybody keeping their head down and saying everything's all right. Now, into this mix, we now have the British referendum, which is set for the 23rd of June, whereby we will be asked to vote whether we remain in the EU or whether we leave the EU. Now, the problem is that if we do leave the EU, you can see that this is going to create some consequences. Firstly, there are a number of other countries that might well follow us. The Czech Republic has already stated, or at least their prime minister has stated, that they could well follow us. We do know also that there's a lot of public pressure for a similar referendum in the Netherlands. And so we've got a situation really where, if we do vote to leave, then the fragile situation that is mainland Europe, and particularly the Eurozone, is going to come home to roost. And the problem, I think, gets a little more difficult than that, because if we see the opinion polls swinging towards a vote for an exit, then you're going to see the markets begin to anticipate a developing crisis in the Eurozone. So I think what we're doing here by trying to take a decision as to whether we stay or whether we leave is actually we're exposing all the fault lines in the whole Eurozone system. And this could be a big, big crisis. And it's also been recognized at the G20 meeting in Shanghai last week, when the finance ministers and the heads of the central banks issued a joint statement and recognizing that this is the big risk, if you like, to global financial stability.
With that outlook on the instability of the Eurozone and the concern that it would likely cause on the part of ordinary investors if they start to see a further cracking of the foundation, what role do you see precious metal ownership playing in people's hedging against that uncertainty?
Well, already, the thing is, I think the timing of this podcast is actually very good, because the prices of gold in particular, silver's got left behind a bit, but might catch up. But the price of gold has really taken off like a shot rabbit. In dollar terms, it's up roughly 19% at the close on yesterday. It's formed a pennant formation in this run-up, which suggests that it's got a further run-up which equals the run into the pennant. Now that gives us a target of somewhere between $1,400 and $1,450. That is if that technical analysis pattern plays out. But also at the same time, we've got a golden cross underneath it, and the whole thing actually looks very propitious. And the performance of gold, I think, it clearly indicates that there is a shortage of stock, and you have got suddenly some serious buying coming in for physical bullion, which is driving the price up. And it's not just a question of hedge funds closing their shorts. That was the initial part of the run. You've really got, I think, some genuine demand in the market now, and this is going to be very, very difficult to contain. And one of the problems from that is that as this run continues, it's going to put a lot of pressure on the bullion banks, because the bullion banks basically have got themselves short, not only in the futures market, but also, I think, to a degree in the forward market, but more importantly, with their unallocated accounts. Because an unallocated gold account is effectively a fractional reserve bank account, except denominated in gold. The bank doesn't actually own the gold, but it's got gold liabilities to its customers. And the higher the price goes, the worse that is for the bullion bank. And I think that there is the potential for a developing crisis in the market, given these banks do have these unallocated account liabilities. So all in all, I think it's a very interesting time. This squeeze, I think, looks like is going to continue. It's going to drive the price higher. And there could be some systemic consequences from that within the gold market itself. But bear in mind that the authorities do not like the world to know about systemic problems in the bullion market. So anything that happens there will basically be kept as quiet as possible. But you might hear some rumors about banks in trouble and all the rest of it. Anyway, let's see what happens.
Well, we are all watching carefully to see what happens, and we really appreciate you being there for us outside the U.S. and giving us the international perspective on this from Europe itself. As always, Alasdair, we just are very grateful for you joining us again here on Reluctant Preppers.
No, it's very much my pleasure. It's been nice speaking to you again.